Hello there, how are you all doing today? My name is Olamide Dolapo Adeleke. I trust you're all well. I usually refer to myself as an ambassador of Christ, and in today's episode we'll be talking about investing for beginners, how to start growing your money. But before we do that, there are two kind of, emotions that people tend to have when they're talking about investments or when they're talking about investing. And the first one is fear and the second one is greed. But mainly we'll be talking about fear today. Anxiety is stamped normal when it comes to investment, because even as humans, it's kind of innate in us to be fearful whenever we want to make big decisions. It's something that can help us grow our money, or even on the other hand, we can lose our money. So, and people have worked and worked for their money and they are not about to lose it. So, the aspect of investment is a very, frugal thing, but getting the right knowledge on what to invest in, how to invest in, and what kind of investor you are can go a long way in helping you become confident about the art of investing. There's a research or a survey that was carried out that said about 55% of Americans will not save or won't save because they think it's only the rich that save. And that's not true. You invest to become rich, and it's not a thing that is set aside for some set of people. And that thing is fear. A lot of people are fearful about this thing called investments. Like I said earlier, a lot of people have worked for their money and they are not about to lose it to investing in things that they don't understand. And getting the right knowledge would help you to maneuver your way in the art of investing, because they don't want to lose their money. Let's just get right into it. I'll be talking about why investment is important. Why is investment important? And I'll be talking about three major reasons why investment is important. And the first one is, before I go to why investment is important, I want to tell you a story. And in that story, let's just imagine that there's a cave, and in that cave there's a lot of rewards, maybe gold, money, and all of that in that cave. And you're excited to go into that cave and get all of those things, gold, money, properties, and all of that. But the person that told you that all of these are inside tells you that there's a lion inside. What will happen to you? You first forget about all the money and all the excitements about the gold that he has told you about, and your focus will be on that lion. The lion with his teeth tearing, his prey apart. And that's the thing we invest in as much as there's a lot of rewards in investments, in investing, we tend to focus on the things that we fear about investing, and that's losing money. And it's normal, honestly it's normal, but getting the right information, like I said, like listening to this, is one step in ensuring that your investment is secure. So I'll be talking about why investment is important. I'll be looking at three reasons why investment is important. So stay along with me, let's go. The first one is investments help you to beat inflation. Investment helps you to beat inflation. So what's inflation? Inflation is just a general increase in prices and a fall in purchasing power of your money. For example, there's an increase in price of commodities, of products and services, but the purchasing power to get all of these products is low. So that's what inflation is all about. So that's why I tell people, in as much as it's very important to save, but you can't just stop there. Because if inflation should happen in an economy, the money you've saved will actually drop in value because of inflation. So you need to move on to the next step of investing. So I was talking about how does investment or why investments help you to beat inflation. For example, gold, that shiny yellow metal, it has intrinsic value. So for example, if you invest in gold, it helps you to retain the value of your portfolio even in rising inflation. So when there's inflation and you invest in investments like gold, the value of your money is still intact. But when you just save it somewhere, maybe under your mattress, I can tell you for sure, brother, sister, that your money is going down. And that's the truth, because money in itself is just based on law of demand and supply. At that particular time, the value of it is dependent on the economy or the purchasing power of people. So that's what investments help you to do. It helps you to beat. Second one is that investments, and the next one, the value of your money. Investment increases the value of your money. I'm sure you have heard of or indirectly heard of the price action strategy. And what does this mean? It means that when you buy, maybe for example you buy stock, you buy when the price is low, and what's the next thing to do? You sell when it is high, so you can get profit. So that's the normal thing. So you can, that's one way that you increase the value of your money, by buying low and you sell high. And it all falls back down to the law of demand and supply. When there's a demand for that particular maybe stock or bonds. Let me just illustrate with a story. For example, if you're in an Arctic climate, the North Pole, where there's a very cold climate, a very cold region, and people are selling ice cubes to you, will you buy it? No, because there's a lot of, the weather in itself is already cold, and there's ice everywhere because everything is chilling cold. But if you're in sub-Sahara desert and you take that ice cube and start selling it to people, of course you're going to get money, or you're going to get value for that particular product you're selling, because there's a need, there's a demand for that, because the sub-Sahara desert is a very hot region. So you can't serve them normal water or hot water, but you need to serve them something that will chill them, that will bring the level of temperature down. And so that's where the ice cube come in. So whenever there's a demand for something, people are ready to pay for that. So that way, when you invest in commodities, in products or stocks and bonds that that are high in value, companies that are termed valuable, when you try to sell it, people will of course rush it because it is valuable. So that's one thing investments help you to do. They increase the value of your money. And the third one is investments helps to ultimately build wealth. Investment helps to ultimately build wealth. What do I mean by this? I'm sure you must have heard about compounding. And for those who have not heard about the art of compounding, it just means an interest on your savings earns you an interest. Did you get that? Okay, so let me explain. You have a savings or an investment portfolio, right? So you invest your savings. So the interest, there's an interest, of course, when you invest, an interest to be on it, right? And when there's an interest on it, that interest earns even more interest. So that's what compounding is all about. Your interest earns you an interest all over and all over again. So that's just the art of compounding, and that goes a long way in helping you to build wealth. So it earns you more and more. Wise man once said that money makes money, and money that makes money makes more money. Did you get that? Money makes money, and money that makes money makes more money. So that's what compounding is all about. Your money making money, and that money making more money. So there's some things that you must consider before investing. So what are these things that you must consider before investing? The first thing is, the money that you choose to invest shouldn't come from your everyday spendings. It's very important, because once you invest that money, you should not come running around and trying to withdraw that same money from your investment portfolio. You must ensure that you set aside money that will be responsible for your upkeep, that is your needs and your wants aside. And you can even set up an emergency fund that you can go to when you need money from, not going to your investment portfolio to withdraw money from. So that's the first thing that you must consider before investing. And the second thing you must consider before investing is how risk tolerant are you? How risk tolerant are you? So how much you invest actually depends on your risk tolerance. And what is risk tolerance? It just refers to the amount an investor is ready to or is prepared to handle while making an investment decision. And there are, let's say, categories of risk tolerant investors. The first one is the aggressive risk investor. This is the kind of investor that makes huge risk, that is able to take huge risk, and dependent on the performance of the market, it can either win big or lose big. So that's the aggressive kind of investor. And the second type is the moderate risk investor. This is the kind of investor that is in between, kind of average between safe investment and high risk investment. So this kind of investor invest in investments that are not safe and that are not too risky. You get the point. And we have the conservative. These are the kind of investors that look for or stay on the side where there is minimal risk. They don't try to do beyond their means. They are very safe in taking risk. So those are the things that you must consider before investing. And you can add this to it. You can project a plan or a goal to achieve your investment decisions. So that's one thing that you can add to it. So those are the things that you must consider before investing. And we'll be looking at some kind of investments for beginners. Investment for beginners. And one of them is mutual funds. So what is mutual funds? Mutual funds is money that is gotten from different investors to invest in financial markets or financial instruments like stocks, like bonds, real estate, and all of that. And the thing with mutual funds is that it is managed by professional money managers. So those professional money managers actually stocks, bonds that they feel that will actually do well, that will beat the market, and they invest your money, actually a lot of investors' money, into that instrument, into that financial instrument. Just see it as a vehicle, a vehicle that contains people's money, and then they invest it into financial instruments such as stocks and bonds, and then of course the investor gets his dividend, his money back in terms of profit. So that's one kind of investment, the mutual fund. And second one is stocks. So see stocks as having a portion of ownership in a particular company. That's just what stocks is all about. A piece of that company belongs to you, so you own a fraction by getting a share. So a piece of that company is called a share. So by purchasing it or by investing in it, you become a shareholder of that particular company. So for example, if you invest in, let's say, Apple or Tesla, and one thing, do you know that if you had invested in Tesla 5 years ago, 2017, if you had invested $1,000 in Tesla 5 years ago, you will be getting a dividend of close to $10,000. That's more than 100% of your profits, or even triple, 100, just more than your profits. So that's the thing with investing, compounding of your money, making your earnings work for you. So just owning a part of a company makes you a shareholder. So you own a fraction of that particular company. That's what stock is all about. Another form of investment for beginners is index funds. So it's just a portfolio of mutual funds, exchange traded funds, or stocks designed to imitate the structure and performance of a financial market index. So what do I mean by this? It's just taking different group investments, and then this is just like a copycat form of investments where you imitate the structure of other index. So index like the S&P 500. So they look at the performance of those companies and they try to copy the performance of those companies, unlike mutual funds that they just try to beat the market. Index funds tries to check the performance of those index or of those companies in that index. So an index can contain a lot of companies. So for example, look at the S&P 500. The S&P 500 is like the 500 largest company in the US. So they look at that performance of the company and use it to make decisions on what to invest in. And when you put money in an index fund, the cash is used to invest in all the companies that makes up the particular index. So the goal of index funds is to mirror the same holdings of whatever index they track. The next investment is the exchange traded funds. And what do I mean by this? It's just like trading exchange in the market. Trading exchange. So like this stocks is a group of contribution by investors to invest in a bag of securities that are traded on an exchange, just like stock. So the ETFs, the exchange traded funds, is just trading exchange, just like stocks. So it's a group of contribution by investors to invest in the bag of securities that are traded on an exchange, just like stocks. So ETFs could contain thousands of stocks that are related and might not even be related. So for example, maybe you're investing in pharmaceuticals or technology. So there's a list of different pharmaceutical companies that are in that exchange, and you could invest in it. So different when you buy fractions of those companies and you invest in all of them. So that's what ETFs are. Or it could even be companies that are not related at all. It can be over diverse companies that are not related, and you invest in all of them. So that's another form of investment that you can look into, the exchange traded funds. And the next income securities or fixed deposits. So this is the type of investment that pays investors a fixed amount of deposits. So when an investor agrees to invest his money, the investment pays you a fixed income or fixed deposit, and then at the end of its maturity date, it returns your money back to you. You are paid your money back. Examples of these are bonds. So what are bonds? A bond is just like an investment product that is issued by corporations or even governments that are used to take up projects or to fund operations. So all of these are just under the fixed income securities, and we'll be looking at bonds and certificates of deposits. So certificate of deposits they are similar to regular saving accounts, only that they have high interest rates, and then they are used within a stipulated period of time, probably from 6 months to 10 years. So the profit there is just that you are paid higher interest rates. The final one is real estate. Real estate. Of course, you know about real estate. We know that lands and buildings, they appreciate in value. And so when you invest in a particular land or building, over time it appreciates in values. And it's not only limited to that. You could also lease land or even give it out to rent. Give it out to rent, and then you get your profit from that. So those are the diverse form of investments for beginners that you can take up. Just look into it and then you find out which one is suitable for you. So how much do you need to start investing? You don't need much, actually. You don't need much to start investing. Just take up what's okay for you and then grow and grow. Grow and grow. Some people actually or there's the 50, 30, 20%, where 20% should be your savings, but it's not suitable for everyone because we all have different responsibilities to take up. So just take something that is suitable for you. Probably you can start from even 3% and then you grow over time. So those are the investing advice that you go on or start on the journey of investing, and take in cognizance of all this importance of investing that I've talked about, and I can assure you that you're good to go. So get the right knowledge, focus on what kind of investor that you are, and that particular emotion of fear, take it down by getting right knowledge, getting the right people that understand the market or whatever you're investing in, whether it's real estate, whether it's gold, whether it is stocks, whether it's mutual fund. Get at least the right knowledge about it. And that's why you can check my other videos where I discuss about finance and all of that. They can help you to have an idea of what to invest in and all of that. So ensure that you get the right knowledge, and don't be greedy, please. Don't be greedy. That's why Ponzi schemes are very popular, because one emotion or one thing that is in human being is the art of greed. So don't be greedy. Don't look out for investments that will give you 200% profit on your investments. There's nothing like that. It's not even possible. So ensure that you are frugal, you invest in the right thing, invest in something that you understand, right? And be sure that you know what you're doing. So my name remains Olamide Dolapo Adeleke. Like, share and subscribe, and God bless you. Bye.